Whether you have $500 in your trading account, $2,000, or even $10,000. In this video, I want to discuss how to grow a small trading account and what advice I would give myself if I started over in my trading journey. Now, what I'm going to discuss in this video is the best instrument to trade. I recommend sticking with one market, and you're going to discuss the market. It's just so you can learn the personality of that instrument. You can identify patterns a lot better, and you're going to be able to identify setups because you learn how that market moves and what it usually does. Now, what is a good account size? How much money should I have in my trading account when I'm first starting out? Now, while that's important, it's also very important to talk about my risk management system, position size, and how much money you should profit or lose per trade when you're first starting out, because this is vital when we're looking to develop a strategy and build an edge. And then I'm going to go over actual trading examples that I have taken myself. That way you can understand how I trade and get some good information out of it to develop your own strategy and build your own edge in the market. That's just going to bring you long-term success. Now, if you haven't already done so, I would recommend following me on my Instagram. I'm going to post a link for this in the description below. I post daily trading recaps along with really good trading tips and tricks that I guarantee you're just not going to find anywhere else. Again, the link for this is in the description below. You're seriously just missing out if you're not following it. Now, what I recommend every beginner trader to do, and I would tell myself this if it was year one that I was just starting out trading, is to start with futures. Futures, in my opinion, are the best instrument for beginner traders or even more advanced traders that have all the knowledge in the world to trade, because they are highly leveraged. They don't require a lot of capital. They do require margin. So with margin, there's obviously risks involved. But with these risks, futures trading enables us to manage risk a lot easier with tools such as our broker would implement certain margin requirements. We could use stop losses. So while they are risky, it requires less capital and they are easier to manage risk. They also could be cheaper than options in Forex. We could trade the S&P 500 future contracts, the ES, the E-minis, for as little as $400. We could trade the NASDAQ, NQ, future contracts for as little as $1,000. Now, this is very broker dependent, so it really depends on the broker that you're using. We can trade, which is what I recommend for small accounts, trade the micro future contracts. The micro contracts are a tenth of the value of the full size contracts. So the full size cost $400 and $1,000 worth of day trading margin required, versus the micro is a tenth of that, $40 or $100. What options could you trade for $40? There's going to be a few, but not a lot. And on top of this, when you actually start making money and thinking long-term, not a lot of people talk about this, futures are taxed probably one of the best instruments at 40% short-term and 60% long-term, which is just going to benefit in the long term when you start actually making consistent profits. So easier to manage risk. They are riskier, but easier to manage it. Require less capital, very small account friendly, and they are taxed better, which are the three main points that it's a no-brainer to start trading futures. Now, on top of this, if we were to just look at this candlestick chart to get a good feel of how they move and how we can make profits, let's talk about how much money we can make or how much money we can lose on this chart. So here we see a very strong bullish candle to the upside, which put in a high at $6,001.50 and the low at $59.50. This is a 51 point difference from the low to high. So if we were to take a bullish position, we would have 51 points or handles in the futures world of profit. If we were to trade the micro ES, the micro S&P 500 future contracts, this would require essentially $40 worth of, I guess you could say, day trading cash out of our account, and the broker puts up the rest of the margin. So one account, $40, and every point up or down, we profit or lose $5 per point per contract. So if we trade 3 contracts, that's going to be about $15 per point. So if we were to just take one contract on the micro E-mini contracts from a low of $59.50 to a high of $6,001, 51 points of profit. $5 per point times 51 points or handles gives us a $255 gain in profits off of, I guess you could say, $40. Again, broker dependent, and it's hard to say this with margin trading. So great profits off of not much capital or requirement out of our own account. Now flip this. One contract is $5 per point. Let's say our stop loss was 3 points away or 3 handles away times 5. That's going to give us a $15 loss on a 3-point stop loss. Now, that's small risk involved in opening up a position trading one of the largest markets in the world that's highly leveraged, where it's so easy to manage and control your risk. Now, like I said earlier, the S&P E-mini contracts, you have to times the micro contracts by 10 because ES is a tenth of the value. So ES is $400, whereas MES was only $40. So times it by 10, one ES full-size contract is $400, $50 per point instead of 5, times 50 times 51 points is it gives us a $2,500 realized gain, essentially off of $400 worth of cash or margin out of our account. This is trading ES. ES is something that I would recommend for once you develop your strategy and build your edge. But in terms of small account, when we're risking or gaining $5 per point, this is the best instrument, in my opinion, to trade are the micro E-mini future contracts. Small capital requirement, easy to manage risk, and they are taxed better once you start making more profits in the long run. Now let's talk about account size. How much money should I begin with? How much should I keep in my account? I am a millionaire. Should I trade with all million, or should I maybe only trade with $1,000 or $2,000? What I recommend doing is starting with an amount you are comfortable losing. I firmly believe this, that you have to lose before you can win. If you want to do this for the long term, you have to lose, you have to go through drawdown, you have to blow up an account, you have to realize your mistakes if you want to win consistently in the long run. With this in mind, start with an amount you are comfortable losing. The more money that you have, the more you can lose, but also the less money that you have, the harder trading it is. If I had to be honest, if you have $200 in your account, $100 in your account, you have no room for error. It's very difficult to even learn or develop something good out of your trading with such a small account size. Now, on top of this, you cannot grow a small account until you know how to grow any sized account. So the trader that comes to me that's a millionaire that says, should I go in with all $1 million? No, start with something small. Start with $1,500, $1,000, $3,000, whatever. Because you have to prove that you can grow a small account. If you can't grow a small account, what makes you think that you can grow a $1 million account? You're going to grow your account, small or large, once you utilize a successful long-term trading strategy. And the point of having a small account, regardless of how much money you have, is simply to develop and learn your strategy in the market. You use a small account in the developmental stages of your trading. That's the only really benefit of having a small account, other than just a capital restriction, is when you have a small account, you're basically looking to develop a strategy and learn about the markets. You learn about your emotions, learn about yourself, learn about things that you should be doing in terms of technical analysis. So once you develop and learn your strategy in the market, your small accounts are automatically going to grow into a large account. And when your account grows, that's when you know you're ready, that you've developed a system and you've built an edge that's going to give you long-term success. And what is that going to do? That's just simply going to develop and instill confidence in your trading, which is a vital personality trait for long-term success. So let's just say we have a $2,000 account that we start off with. This right here, this slide is vital. Regardless of how much money you have to implement this. Nobody talks about this. Nobody does this. And this is why so many traders fail and struggle, is because they have to implement this right here. It's so key. If you learn anything out of this video, it's this right here. Keep your risk consistent, regardless of account size. Know how much money you are willing to risk per trade. The rule of thumb is 2 to 5% of the account. 5% is more on the risky side. But let's just say we risk 3% on a $2,000 account. That's going to give us a $60 risk per trade if our stop loss hits and we're wrong on the certain trading setup. Every single trade that we take when we have this $2,000 account needs to be risking $60 in this exact example. What a lot of traders do is if their normal risk is $60, some trades they may risk $100, or some trades they only may risk $20, and they do not keep their risk consistent. The risk should be very consistent on a trade by trade basis. The reason for this is if we maintain a 2-to-1 or better risk to reward ratio, when we keep our risk consistent, our risk will be around $60, and maintaining a 2-to-1 or better, our reward will be $120 or higher, $150, $200. So no matter what, when we keep this number consistent and this number inconsistent with the minimum of being at least a 2-to-1, when we're right on a trade, we make $120. When we're wrong on it, we only lose $60. The next trade, we win $150. And the next trade that we lose, we're only $60. This is how we get an uptrending P&L curve, which will enable us to grow our account. We're taking 2 steps up and only 1 step back. When you do this the flip side, and maybe your average win is $120, but your one loss not keeping your risk consistent is $100, now the dip is much shallower, and another loss will compound it, and your account will slowly bleed if you have larger losing trades and you do not keep your risk consistent. And we must adjust our position size relative to this risk. Now, what I mean by that is I've highlighted our average risk of $60. If our average risk of $60 is here, we have our contracts on the left side, 2 contracts, 6 contracts, 10 contracts. And on the top, we have a stop loss. Maybe our stop loss on a trade is only 2 points. Remember how I said earlier, 2 points equates to $5 per point per contract. So if we trade 2 contracts, per point is going to be $10 times 2 is a $20 loss. Now, the more contracts and the wider the stop loss, the more money we're going to lose. This is just a little calculator that I just created before I even started recording this video. So if our stop loss is 6 points away and we trade and our risk is $60, that means we could only trade 2 contracts. Versus if our stop loss is only 2 points away, that means we could trade with 6 contracts. You see how we adjust our contract size relative to the risk involved? And the risk is going to be different on a trade by trade basis because our stop loss has to be dynamic and prove our analysis incorrect. And every single trade is going to be different. So it's vital to adjust the contract size relative to our risk, which we're going to keep the same, but our stop loss is not going to be the same in terms of points on a trade by trade basis. Sometimes some trades are going to have a wider stop loss, which is going to require me to size down. Some are going to have a really tight stop loss, 2 points, 1 point. That means I could size up for the trade. I'm adjusting my size relative to the position, but I'm keeping my risk consistent on a trade by trade basis. This is so key that every single trader has to implement. I do this on a daily basis, and it's what enables me to have consistent success in the long run. Now, as I said earlier, we have to keep the losses small. We're going to start developing our strategy by having a small account. This account needs to be used just simply to learn so much about the markets and about our emotions. In this process, there's going to be so many trades that we're going to profit on, and there's going to be so many trades that we're going to lose on. If we implement that risk management that I just said, then the losses are going to be controlled. But this data, win or loss, small win, smaller loss, right? We should never have a large loss when we're developing or have a small account. It should be win, large win, and small loss. This process, you're going to learn so much. It's the most valuable and crucial aspect to your trading is in these developmental stages with the small account. Because when we implement proper risk management, we learn a solid trading method, and we can narrow down our psychology. This is when we have an edge in the market, and our edge is going to enable us to trade with confidence that when we open up our computer on a daily basis, we're going to go in with confidence that we know what to look for and we know what's going to give us long-term success. So when we have this data with the small account, large win or small loss, it's important to dissect it, replay and review the data, win or loss, and learn common similarities, common patterns on things that you should not be doing and things that you should be doing more of. When we have the smaller account, our losses are so small that the losses should not affect us monetary, financially, and most importantly, mentally. So key right there. Now, in terms of what I use supply and demand combined with order flow. Price and volume are the only indicators that I need and what I would recommend every other trader to use. Now, the reason for this is because we're trading the S&P or the NASDAQ, I only trade, or 90% of the time trade the S&P. They're the overall markets themselves. They are global markets, and because of this, they are highly liquid. They're the most traded market, or one of the most traded markets in the world, which means they work very well with supply and demand imbalances combined with reading volume patterns such as order flow. For example, the market here dipped down into this level of demand where it bounced. As the market was dipping down to this level of demand, you can see large green bubbles here. What this indicates is there's large buying volume here as the market is dipping down into this level of demand. This, to me, is so powerful when you combine this strategy with the risk management system that I just explained earlier. For example, a really good trade that I recently taken was 30 ES full-size contracts, and I gained an 18-point profit or a $27,000 gain. My risk was around $4,000, and again, I'm giving this example to show you the power of futures trading with this strategy, but think about this in terms of micro contracts. If we were to gain 18 points on one MES contract, $5 times 18 is $90 worth of profit on only $10 worth of risk. So that's going to be about a 6.5 to 1 risk to reward ratio. And the thesis for this trade, now we can understand the strategy a little bit more. And I would recommend everybody to go through my channel because I have a lot of videos in terms of trade reviews and my overall strategy and what I look for on a daily basis. But over here, the market, S&P 500, sold off. And on this sell-off, the market formed a level of resistance or supply from very large selling activity. So my thesis was to short a pop up into this level of resistance at 60.63, which is highlighted by this pink box, with a 12-point gain and a 3-point stop loss. The reason why I took this trade is looking at the order flow and looking at the volume. Again, if you're confused by any of this, I would recommend checking out the other videos on my channel, especially the order flow series. I'll post a link for that in the description below. But over here, we can see a very large red bubble, which is a very large seller. Marking this as a level, the market rallied into this seller, which was this large red bubble, and rejected where this seller then resisted the market. And this is where I was comfortable taking the market short, capitalizing on a strong sell-off to the downside. And what it looks like on the candlestick chart is a rally into this selling activity and a strong rejection targeting the low of day at 60.52. And even if you trade the micro contracts, one single contract, an 18-point gain on 2 or 3 points worth of risk is a 6 to 1 risk to reward ratio, $10 worth of risk for a $90 gain. When you do this consistently, this is how you grow your account. Even if you lose on the trade, a $10 loss is very minuscule. Here's another trade example that I took. So the market was selling off and dipping down into some buying volume and buying activity. This is what I mean with supply and demand combined with order flow, being able to read the volume and the orders coming into the market. It's the most raw, organic, and authentic way the market actually moves, because the only way the market moves up and down is if buying or selling comes in. So being able to read it gives us the best edge. So the market dips down into this level of demand, and this was a 15-point profit for 3 points worth of risk, or a 5 to 1 risk to reward ratio. So even if you traded, let's just say one ES contract, 15 points times $50 is a $750 worth of profit for $150 worth of risk if you are incorrect on the trade. That's trading the big boy ES contracts. But the thesis for this trade was simple. The market was selling off into this level of demand, into VWAP, which is the purple line, into the downtrend line, price and volume. On top of this, there was buying volume highlighted by these arrows at 60.43. Pulling up the heat map, you can see the large green bubble there, the large red bubble there, and then some large selling volume coming into 60.43, where I find an entry long, dips perfectly into this level of demand, and rallies and breaks the high a day, which is my target, because majority of the time my targets are high days. And that was this setup for a $26,000 profit. And it's important to keep losses small. My losses compared to my wins, minus $4,500, minus $4,000. None of these compare to such a large winner with good risk to reward ratios. You see how my losses are very consistent? $4,500, $4,100. They're around the same risk because I am keeping my risk consistent on a trade by trade basis. We have to keep these losses small. Trading is the most scalable business. 1 contract, 10 contracts, 100 contracts. It's all the same. What I'm doing right now is the same thing that I would do trading 1 MES contract. Stop trying to hit home runs and grow your account without a strategy. A lot of traders swing so hard for the ball coming at them and they blow up their account and don't learn anything from it. Consistent base hits only add up when you utilize a proper strategy. Think about this. Consistency brings repeatability. Repeatability brings scalability, because all you have to do when you want to scale up is increase your risk. And once you increase your risk and scale up, that's when you're going to have growth or profitability. You want to have consistency because consistency is going to bring you repeatability. When you have something that you can repeat, you could scale that. And when you could scale something, that's when you're going to grow and build profits. Detach from the money and focus on the process. And just to validate all this, especially from traders who take this advice seriously, this trader in the invested trade community started off trading 1 to 2 micros, and now he's trading 20 to 30 full-size minis. It's been a grind, but ended 2024 up 600% year to date trading future contracts. And here's another trader, been using Bookmap and order flow this month, and it's changed the way he's traded. Solid profits. We could argue the risk management could be a little tighter, Kevin. I'm not going to lie. But when you use the power of the order flow and the power of price and volume, that's when it makes a huge difference. And just similar to this trader right here. So trade small size, trade the micros, build your system, learn from your losses, keep your risk consistent. And this is when you're going to develop your strategy and build your edge. Small base hits add up. Stop swinging for a home run. Listen to this advice and you will start seeing a difference, especially in the developmental stages of your trading. If you learned anything from this video, I would appreciate a thumbs up. If you have any questions, comment them. And if you're new to my channel, I would appreciate if you would just subscribe to it. But I'm ending it. Peace out.